Hello, YouTube. The wipeout on Apple stock is starting to really accelerate. We have a $200 billion decline in 2 days. This is very important because we've now fallen back below our previous 2021 and 22 tops. We talked about that yesterday, which means that, I don't know, we're going to go all the way down to 135, but man, does that make a good thumbnail? So let's go through and see exactly what is happening. Let's look at this one-day chart because this is really what we were looking at yesterday. And what we noticed that we've had a dead cat bounce all the way back up. We didn't quite fill the gap that got inside of it. And then a massive dump is starting here. So what caused the news? What can we do with it? And where are we going to go from here? All right, well, let's have a look here. Apple shares fall after report that China banned iPhone's use in government employees, which means that we're seeing other names also get hit. Those names include names like NVIDIA, like Tesla, but a lot of them actually snap back before the close. Why does this matter though? Well, it matters because when we look at a 1 week or a 1 month performance, it looks pretty red. And we know we were kind of expecting this because this is supposed to be the worst month of the year. Let's see whether or not there's any more damage in store. So clearly there's a lot of red. Apple, NVIDIA, AVGO, JP Morgan. What's green though? Oil and energy. And this is not good. And it's not good because there's a very simple thing we want to look at here, a higher time frame. And on this higher time frame, what do we notice? Well, we notice that there is a pattern of red, right? Energy is clearly very green, but otherwise, like it's starting to look like this energy. The oil prices could start to be a little bit more troublesome because when we look at a different graph here, we note that. Let's just go to my Twitter account, link in the description if you want to follow me. Here we're comparing CPI of the 1960s and 70s and 80s to basically where we are now. And this move back down and then back up could be quite bad. So if the bears won, this is something I'll be looking for because oil drives CPI. That's a very important thing for us to remind ourselves of here. And in the last 30 days, it's been up. So if we have a look here at CL1 or oil, right, light sweet crude, man, golden cross, chart moving up, that's pretty bullish. So we look at the daily chart, it looks good. We look at the weekly chart, man, there's a super mega bullish pattern inside of here. There is. And we are over the 50 MA. And I think we're at a new 52-week high. Yep. We're at the highest level going back to November of 2022. So the slide in Apple is what really started it. But then it kind of bled through to names like Tesla, like NVIDIA, because there's some fears that things could be getting a little bit worse. We have to remind ourselves, too, that Apple actually pulled out of China in part to go build stuff in India. It could be a tit for tat where they're like, hey, if you're going to pull out, well, we're going to pull out too. I'm going to ask you for a huge favor, please and thank you. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really, really appreciate that. Thank you very much ahead of time, and I appreciate your support. We also had a bit of a warning here where we mentioned this to our group. It's a couple of days past now, so it's currently the 7th. On Tuesday, market was closed on Monday. On Tuesday, we got a warning. SH and PSQ were due for swing alerts. They're up by 1 and 1.2%. And that's important because when we look here to our chart, SH and PSQ saying they're going to go up means the market's going to go down. And by being back above their short-term price or that 50 MA, it's a really important clue for me. I think we could be going higher on PSQ, going higher on PSQ and SH, which means the market might be going down. We also mentioned before that we had higher time frame charts, including the weekly one. And when I look here at PSQ, it's battling, right? It's like the final boss. It's like having such a hard time here on this downtrend. So we can note that as we look here at our double downtrend, this is almost the same as looking at QQQ, but it is inverted. So we note that our primary downtrend is currently getting battled for, but our second one here has actually already been claimed. So we look at PSQ, it looks like maybe it wants to stop going down. We can look at QQQ to see the opposite version. This actually doesn't look all that bad. We looked at this yesterday. We looked at this and said that while we're still holding our uptrend, we're just below our 70% retracement. That was the fail we talked about on Tuesday, Wednesday. And this doesn't look all that bad. So it really depends on what chart you want to look at. And this uptrend right here is the corresponding downtrend we note over here on PSQ. So the downtrend we note is just the same thing as the uptrend on QQQ. Anyways, what's really important now is that we have this pattern where we come down, we bounce off the uptrend, we go straight up until we make a higher high, basically all hollow candles inside this period. That's not the case here. We went higher, didn't even get in inside and fill the gap. The gap's still a little bit, is it actually filled? 380.69. We hit 379, sorry, 380.83. Gap has been filled. So we hit the gap and then we rejected. So high, lower, high, lower, high. We'll see that same thing here on the weekly chart, right? We got lower highs here. Why is that important? Well, because it looks like we're trying to form some kind of a sloppy W where we could still make it to the high, but we have that seasonality, which tells us that right now it's like tough. It's tough to go up. So this is not really playing out. It was potential. So what I'm going to do now is actually delete it because it's not really acting as a good guide. But here's the important part. Where did we close today? We closed today at 372.06. We closed cents below our 50 DMA at 372.19. 1 day below is not so bad. But when we look over here to SPY, can't get those words out. We got 2 daily candle closes below. We also talked about this yesterday. So 2 daily candle closes below the blue line. That is no bueno. That is no good. That is not what we want to see. And if we go here to our below 50 DMA list, let's just go through fast to see whether or not other names are in here because we want to know if the bears won. So all we're going to be looking for is to see whether or not we are above or below the blue line, notably for how many days. Let's go through. So here we got XIU or Canada. So America down, Canada down 2 days in a row. What else we got next? QQQ, it has only been one. We look here to SMH, only one. We look here to NVIDIA, bouncing off the 50 DMA. We look here to Apple, 2 days below. That is the start of a potential trend change. Tesla, 2 days below. FXI, 3 days below, but 4 out of the last 5. Microsoft, below. ARC, below. DAX, below. EEM, way below. Nikkei, actually above. This is Japan. So Japan actually looks pretty good here. It doesn't look terrible, right? Wow, okay. Ethereum, below. Death cross, yep. Maybe there's going to be some more pain ahead. Bitcoin, pump it, dump it, and go nowhere. It's way below, though. Death cross is in the making, not quite there. So the blue line is going to go below the black line. That's a death cross. 50 below the 200. And now we're back to SPY. So 2 days below means, man, we better make sure we understand we could be going lower. The seasonality chart tells us that, the September chart says we could go lower. I don't know that we're really going to get a power slam unless we get back down here into fear. What I would note is that the fear and greed is lining up roughly with what we're seeing on the chart. So come on, timeline. So we go high, lower, high, lower, high, lower, high, a dead cat bounce, higher, high, and then we're trying to form a higher low. Is the higher low going to hold? Well, let's go back here to our weekly chart and just see what it tells us. Why? It's a very simple story. And I like simple stories. If you do too, please smash that thumbs up or subscribe to the channel. Thank you so much ahead of time. So we had our 5% dip, then a dead cat bounce or an inside bar. That was this week right here, going back to the 21st. And then last week, we broke to a higher high. But the challenge is that we did not actually go back above. Why does this matter? Let's make it simple. Because we now have 1, 2, 3 weekly higher lows. We talked about this yesterday too. So we formed defense 3 times. But we've only actually formed 1 higher high. That was last week. Now we're back to an inside bar. So what does this mean? The bulls are playing defense, but they're not really playing offense as of right now. So what should we expect? Well, we shouldn't expect the chart to go higher unless they're going to be printing those weekly higher highs. We're actually at risk of losing last week's low going into Friday at about 439, basically 440. So if we have a 1% decline tomorrow, we would be below last week's low. This really matters because what it tells us is that we're now back inside that inside bar. So whichever way we break, it's probably going to be the short-term direction. What does that mean? And if we break this bearish, we could be going down. If we break it bullish, we could be going up. And the key area I'll be watching for going into next week happens to also correspond with the exact same thing we're looking for. For us to print a weekly higher high next week, we have to make it over 452, basically. It's 451.06. I'm going to call it 452. Why 452? Because I don't want a couple cents, and also it corresponds with our 70% retracement here at 451.76. This is just a mathematical number, which tells us that if the market's going to retrace, that's why it's called the Fibonacci retracement, it's going to make it back up over that area if it's going to go for a 100% retracement or back to the all-time highs. This is important because it was our clue on the QQQ chart for that exact same thing. S&P fell below first. And then QQQ got dragged down, kicking and screaming. It's 375.66. But once we lost it, that was the start of the decline. So we dead cat bounced off there on Tuesday. We fell below on Wednesday. And now we're fading a little bit further. So this is going to be important because we also want to keep in mind that if we look here back to our chart, we want to be mindful that the dollar is up again, right? So it's up by about 0.76 this week, or just under 1%. We look at QQQ, it's currently down by 1.5%. And then the S&P is currently down, looking at the number right here, by about 1.4%. So the market is actually taking the dollar move and then amplifying it by about 2x. I would also note that VIX is down. On the week, it's up by 10, but it's in the low teens. Low teens means the market is calm, cool, tranquil. So if the bears are going to win, they better get this. They better get us back down into fear, and they better jack this VIX up. Right? It was up 7% earlier today, and it's back to red. Right? Good old Mr. Red, our favorite man. One more thing I want to note here is the 2-year note and the 10-year note, because they are green in the week, but they're losing some steam. And this is very important because it means the market's kind of rolling over on its own. It's not getting huge competition from the bond market, even though there is some. And this is important because we also talked about our crash signal, where the US 10-year note versus the S&P, or basically our W pattern, when we break to that new high, that led to a crash. This led to a crash. I'm not sure that this is going to lead to a crash quite yet, but we've already breached it, which means we do technically have a new 52-week high right here, but we haven't held it. We got to rally up above 4.34 to really hold that area. And I'll show you why it matters. Because if the bears are really in control, this is the pattern we were looking at. This is SPX, or the index for the S&P. We're looking at 3 red candles. It's this pattern right here. 3 red candles, 1 dead cat bounce, and then a bearish engulfing candle by the end of the week. Why does this matter? Well, we got 3 down weeks, 2 hollow candles, and then the red, which means we're not tracking this one. We're not tracking this one. But if we close red, or if we keep fading, notably back below our relative high here, I'm looking at the 5% off the top high, 43.76. That's going to be about 436.50 for the S&P. That's a really important area. It would mean that we're basically going back to our monthly low, and we're not sure if that's going to hold. Seasonality chart says we should, but should does not mean it will. And what we're really talking about here is this pattern, where if we look at a 1-month chart, give me one more second here. If we don't hold that inside bar on the month, basically coming back down to the low and then blowing it out or going below it, this could be invalidated too. Just like that QQQ daily chart was a good pattern until it's not. Right? Everything's bullish until it's not. So that's really what I wanted to focus on today. I think one more thing we want to be mindful of is that going into the Friday close, there's going to be some important other markets we want to look at. So let's just finish off here by looking at the DAX, and then by looking at FXI, EEM, and then also the rest of the world. So right now, the DAX is only down by about 0.7. That is not terrible on the week. It's really just adjusting its all-time high and putting in some kind of cup or some kind of flag. It's really turning into a megaphone here, though. So watching that one closely. Emerging markets, to get a good gauge on the rest of the world, back below the 50 weekly moving average. That is not bullish. It is not constructive, and it's down by about 2.5%. Looking at FXI, because the news did come out of China, man, China kind of stinks. It's down 4%. So whatever news they think they're doing, or whatever harm they think they're doing, they're really hurting themselves more than anyone else. Look no further than BABA. BABA's down by 5% this week, back below, right on that 50 weekly moving average here. So that's important. We're going to look at one more here. We're going to look at the Nikkei. So looking at the Nikkei, because it's the strongest one, man, the Nikkei looks pretty good. But we got high, lower high, and lower high. So we got 3 lower highs here. It's forming a bit of a channel or a flag, right? Pop, flag. If it's going to pop again, we better make sure we see that soon. Lots of volume here. Could really get washed out if we start going sideways to down. So with fear and greed here, like I mentioned, if this is going to be the high, it's not going to be that difficult for us to fall back below 50. That could signal the bears are back in control, and it's the market's going to be getting a nice little haircut. With that said, thank you for tuning in. The weekend review is now queued up here on the left-hand side. Thank you so much for tuning in. I look forward to seeing you tomorrow, and come hang out with us on our live stream. If you want to come hang out for the final hour, we're going to have a stream. It's scheduled right here, and we're going to talk about whether or not this is currently a trap. Thank you for tuning in. I will see you guys tomorrow.